Welcome back to The Edge. Today we go beyond basic allocation into strategies that most retail investors never consider. These are not get-rich-quick tactics. They are systematic approaches that institutions have used for decades, now accessible to individual investors through modern tools and automation. Strategy 1. Factor-based investing. Market cap-weighted indexes are not the only way to invest. Academic research has identified factors that historically outperform over long periods. Value, stocks trading below their intrinsic worth based on fundamentals. Size, smaller companies that have historically outperformed large caps over time. Momentum, stocks that have been rising tend to continue rising in the short term. Quality. Companies with strong profitability, low debt, and stable earnings. Low volatility, stocks that fluctuate less than the market have shown surprising outperformance. You can access these factors through specialized ETFs. The key is understanding that factor returns come and go. Value might underperform for years before surging. Momentum works until it does not. The systematic approach is diversifying across multiple factors rather than betting on one. Implementation: consider allocating 20 to 30% of your equity exposure to factor ETFs. Split this across value, small cap, and quality factors. Rebalance annually. This is not about timing factors. It is about capturing the long-term premium they have historically provided. Strategy 2. Covered call automation. If you hold individual stocks or ETFs, covered calls can generate additional income without selling your positions. You sell call options against shares you own, collecting premium in exchange for capping your upside. This is not speculation, it is income generation with defined risk. How it works. You own 100 shares of a stock or ETF 2. You sell a call option with a strike price above current price 3. You collect the option premium immediately. If the stock stays below the strike, you keep the shares and the premium 5. If the stock rises above the strike, you sell at that price, still a profit, and keep the premium. Automation approach: build a tracking system that identifies when to write covered calls. Set rules. Write calls when implied volatility is elevated. Target strikes 5 to 10% out of the money. Choose expirations 30 to 45 days out. Monitor positions for early assignment. This is not passive investing, it requires attention, but automated tracking and alerts reduce the cognitive load significantly. Strategy 3. AI-powered investment research. AI can accelerate investment research without replacing your judgment. The key is using it for the right tasks. What AI does well. Summarizing earnings calls and financial reports. Save hours reading transcripts. Get key points in minutes. Comparing companies across metrics. Ask for side-by-side comparisons of fundamentals, competitive positioning, and valuation. Explaining complex financial concepts. Get clear explanations of terms, strategies, and market dynamics. Generating research questions. Ask what you should investigate before making a decision. What AI does poorly: predicting stock prices. Anyone claiming AI can reliably predict markets is selling something, providing real-time data. AI models have knowledge cutoffs. Always verify current prices and data. Making decisions for you. AI is a research tool, not an advisor. The decision is always yours. Tools like Perplexity Pro excel at sourced research. Use them to find and synthesize information, then apply your own judgment. Putting it together, advanced strategies require more attention than basic index investing. That is the trade-off. You're exchanging time for potential outperformance or income generation. The systematic approach. Core holdings on autopilot, 70 to 80% in automated passive investments. Advanced strategies with attention, 20 to 30% for factor tilts, income generation, and active research. Tracking and review, monthly check-ins on advanced positions, quarterly rebalancing. This is how institutions think: a stable core with satellite positions for added return potential. You can build the same structure. Next week, Preview Tuesday, the year-end financial audit. A complete checklist for closing out 2024 and setting up 2025 for success. Friday, building your 2025 wealth roadmap. Goal setting that actually works, with automation to keep you on track. Build the advanced layer. Capture the edge. Compound systematically to your systematic wealth. The Wealth Grid team.